We're half an hour from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Rebecca Choong Wilkins with David Ingles.
Let's get to your top stories. This Friday morning, stocks across the Asia-Pacific trading cautiously as investors await this fairly crucial U.S. jobs report for fresh clues on the path of the Fed ahead. Top officials signaling rates will be on hold for a while.
And Chinese developer Country Garden proposes new terms to slash debt and lower borrowing costs as it inches towards an offshore restructuring.
And President Xi Jinping reportedly sending a high-level official to Donald Trump's inauguration, a move meant to ease friction with Washington. Right, quite an eventful first full trading week, hasn't it? Really been. So we're wrapping up really what's been, I think, generally speaking, not a very good week for risk assets. Outside of the U.S., of course, for example, EM's a good example of that, and we showed you that at the top of the show. We did enter into a technical correction on the EM story. A lot of that is a China story. A lot of what happened there is really a 10-cent story as well. MSCI Asia Pacific, as we mentioned, trading cautiously going into the weekend here. So we're down about 0.3%. The dollar, mind you, 13.13 on the Bloomberg Dollar Index. On Dixie, on the DXY, we're actually at 109 and change. On track for, 14 weeks of gains in the last 15. A couple of headlines coming through here out of the PBOC, maybe suspending the purchase of government bonds in the market. We'll dig into that story, and I suspect, given how that is phrased, we might be looking at some efforts or targets here as it pertains to liquidity in this market. That's number one. And number two, I guess, this impossible trinity in this conversation around where you have to go with the exchange rate, where the yield is, for example, and flip the boards, you have a look at the yield and the exchange rate there as well. And also, interestingly enough, this is perhaps not as visible outside China than it is inside. The PBOC-backed newspaper, change the boards, please. The Financial News is somewhat pushing back against the sort of the notion of that shift in monetary policy stance, right? Do not overinterpret what that means. Question mark is, might that mean less aggressive stance coming out of the PBOC? In fact, when you look at the swaps, for example, the swaps curve actually inverted. It's a bit more technical, but maybe the markets are paring back expectations of how early or the magnitude of monetary easing in China. 10-year yield, 165, 166 right now, and of course MSCI A50 futures doing this. We're flat going into the open today. But yeah, we're still on bear market watch, aren't we here, Rebecca?
Yeah, very interesting there. Just thinking about some of that PBOC news that has come through that you mentioned there. There's the PBOC saying that it may resume government bond trading depending on that demand. But the story really for them, seeing more demand than supply when it comes to those government bonds. I mean, elsewhere, we're also looking at the CNY, as you say, this impossible trinity that they are trying to manage. We have this CGB sale coming in. We've had that story of these unstoppable bond yields, the 10-year, of course, going to that record low earlier. We're also entering the window for credit data, so a little bit more potential information about some of these sort of follow-through on stimulus moves through the market. Stocks, as you say, the bear market, that's coming through. We're on watch this week. A lot of weakness after Tencent was added to that Pentagon blacklist. We are on day 3 of that buyback, really underscoring the efforts and the intensity of Tencent's efforts to try and offset some of the uncertainties around that addition to the blacklist. Tencent, of course, saying that that is a mistake. And elsewhere, this Bloks debut in Hong Kong, this really sort of frenzied buying that we have seen. And finally, this TikTok hearing on Friday. We're going to see that, the U.S. Supreme Court.
Yeah, lots to get through there, including some of the changes from the sell side here, looking at Goldman and the banks, for example. This call out of JP Morgan, which didn't get to because of the breaking news right now, that they actually think this bear market in China might be temporary. They do expect a bounce post-inauguration later in the month. Okay, more on this breaking news. PBOC, as we were just pointing out, there might resume some of the operations depending on what the market situation is. A lot of that also has to do with the fact that the conversation around the Fed is now just one full rate cut priced by markets this year. Mark Cranfield joins us to talk us through all these headlines. Mark, why don't we get started with the PBOC? And I'm not sure if you'll be able to have a look at that in detail. What do you think on the surface this means?
On the surface, and there aren't many details yet, this is a desperate measure. And these kind of things are full of unintended consequences. It is not advisable for central banks to get really heavy-handed with the normal working of a market. When you tell people they cannot buy or they cannot sell something, that usually has pretty wide repercussions for people that rely on clean, open, day-to-day trading activity in their markets. So we need to know a little bit more about what they're trying to do here. No doubt it will help to push up long-term yields to a certain extent, but it could also have much wider implications of what it does to short-term, what it does to the yuan, what it even does to the mood in the equity market as well. There aren't many details yet, but this kind of measure looks extreme and desperate and will not be taken well by investors.
Mark, just thinking about some of those desperate measures, the environment that investors are operating in, tell us, what about the bad start to the year for Chinese stocks?
Well, it's really got a lot to do with the speed with which the measures, although there were a lot of stimulus measures announced around September, October last year, obviously most of those are medium to long term, and investors don't have the patience to wait for it. We saw a huge spike in equities across the board, both in Hong Kong and China, through the end of September, early October. Some of that is unwinding. There's not much further to go before we're almost back to where we started. And that's investor impatience. They threw a lot of money into the market and they want to see quick results. Well, that's not going to happen with the kind of policies which are being put forward. It will take a long time before it shows up in the data. And clearly, the most recent China data is not that encouraging from that point of view. By the time we get to the second half of this year, the picture may well be different. By then, we'll have a clearer idea on how China is being affected. If there are new tariffs from Donald Trump, the domestic work that they're doing will start to improve the economy there. They may well get close to their 5% growth target. But those things are longer term, and the markets are notoriously short term in their thinking. They want to see things happen in the next 1 or 2 days. And that's what you're seeing now. People just losing patience with the results coming from the China stimulus.
Mark, to the other side of the equation here, the Fed, the jobs report's coming out. Funnily enough, this time last year, markets had priced 7 rate cuts. Now, looking at the Fed fund, the futures curve, we have just one full rate cut is priced. What is the risk to that projection at the moment?
Not a huge risk in the short term, because I think there's a general assumption that the Federal Reserve will be on hold at least for the January meeting and probably for at least one more meeting beyond that. People are not going to assume too much. Donald Trump is about to be coming as president. We've still got discussions to come on the debt ceiling for the United States. Some people are even calling for it to be abandoned at all. There's a huge amount of uncertainty on policy, which means that the Federal Reserve will want to take a back seat for a while. They won't want to do too much. Investors are well aware of that. It gets a lot more tricky when you go into the second and third quarter. By then, we will probably start to see the impact of whether or not, if there are new tariffs, what are they doing to the global economy? By then, also, we may start to see inflation start to tick up in the United States. And there could also be some cracks appearing in the US jobs situation as well. That's not necessarily going to happen just yet. So it's a stalling period for now. That's why bond yields have priced back up. What gets much more interesting is really once we get beyond the presidential inauguration, and once we see the data coming through in February and March, then traders will probably get a lot more aggressive on whether the Fed can or cannot lower interest rates later in the year.
Mark Cranfield in Singapore for us, I'm analyst strategist. And just to reiterate, of course, the JP Morgan call, since Mark mentioned that inauguration, that their call is, that might serve as the trigger for a likely rebound in Chinese stocks shorter term beyond going into the latter part of this month. Okay. Here, more breaking news, more market reaction to the breaking news out of the PBOC. The 10-year yield is up now 4 basis points. Some strength coming through in the Chinese currency on the back of what Mark just described there as a desperate measure. Christy, investment strategist, Franklin Templeton Institute, joining us to talk us through the key market themes. And Christy, I was going to ask you about the Fed and the dollar, but this is forcing my hand right now. What's your hot take over this decision, at least the announcement from the PBOC, that it will be pausing temporarily bond purchases?
Well, I think it is definitely a countermeasure to deal with the falling bond yields. And we've seen this, unprecedented moves in Chinese government bond yields decline recently. And that is at the point where it is actually putting a pressure on the RMB. So all this is manifesting into some kind of a response function from the PBOC, understandably. Now, I would like to also point out that, in December, during the Politburo meeting, there was a statement that suggested some changes in phrases like for fiscal, from counter-cyclical policy to extraordinary counter-cyclical policy, and fiscal policy will be even more proactive. When it comes to monetary policy, which is, of course, the PBOC's main mandate, it's shifted from prudent to appropriately loose. So I do see that, that change, and that is actually a shift from a 14-year-old stance of being prudent to the expression of appropriately loose. I think that still governs the overall monetary policy direction, which does suggest that the PBOC will continue to cut rates. And, at this point in time, some of the adjustments, normalization, perhaps, if I could use that word, on the government bond yields, that will potentially also set the stage for the rate cuts going forward, triple cuts going forward, and at the same time, further, downward pressure on bond yields.
Christy, last time you spoke with us, you joined us at the end of last year. You talked about the potential for this sixth mega rally for Chinese equities, a bump up maybe 50, 100% for the CSI 300. Tell us, are we still on track for that? How have you adjusted your forecast, if at all?
Well, I think that really we are looking at some of the, and I definitely did qualify that there are certain conditions that have to be met for that to happen. Is that happening? Some of that, yes. We do see some of the measures that have come out. And I think this year will actually be a pivotal year for stress testing China's policy commitments. Now, why do I say that? Because this is the year where China actually concludes the 14th five-year plan. So it is even more crucial for Chinese policymakers to be able to deliver its economic development goals. And at the same time, these goals face external headwinds. I think we're all familiar with, the potential risks from tariffs and potential risks from effectively, all the regulations on Chinese technology and, some of the companies that have been put on the list. So all this sets the stage for a lot more volatility. And I think Mark alluded to that lack of patience that investors have. And I would also point out that, there's a mismatch in expectations. So investors do expect the PBOC to do much more. And yet, the expectations of fiscal policy seems to be quite underwhelming to the extent that, any kind of news that comes out, it does look like the PBOC has to do more, and the government fiscal stance will have to deliver much more than what is expected as well. So the mismatch in expectations and the lack of patience on investors' part is definitely headwinds for any kind of sustainable rally in the stock market. But having said that, we've seen some of the, I would say, green shoots coming out, right? Especially for stocks in Hong Kong, Greater China, where there are some, optimism towards some of the IPO counters. So we've seen some of these green shoots, and hopefully, we can only hope that all these policy commitments delivery will actually help to continue to provide that kind of upside lift to Chinese equity markets.
Yeah, Christy, I do remember that conversation where you did qualify certain conditions need to be put in place. The market's looking at the Chinese side of the equation and say maybe policymakers haven't done too much. These markets, I'll bring in the U.S., don't trade in, I don't know what the phrase is, mutually exclusive vacuums, right? So could it be, and just, humor us with this, could it be that Chinese markets are not doing well? And you have a survey out, S&P 500, 6,400 to 6,800. Could it be because of an external factor, the U.S. markets are doing well?
Absolutely. So you point out a really good point. So we've seen in the last 4 to 5 weeks when the U.S. markets actually entered the consolidated phase. And if you look at most of the indexes, be it S&P 500 all the way to R2K, they have actually entered oversold territory. So, and if you look across the landscape, this is definitely something that is dragging a lot of major equity markets globally downwards. And I would say that that is one key external factors that is also, putting that negative tone on Asian equity markets and including China. Now, what are the key risks for U.S. equity markets? Firstly, is of course higher yield, higher bond yield, and we do experience that as well in the U.S. And at the same time, earnings. So as we go into the next few months, and especially after the inauguration of President-elect Trump, we'll see a lot of changes. So I would say in the near term, there is some, the environment is actually quite precarious for investors at this point in time. But we do see that what's happening with the U.S. Stock markets at this point, as we're not turning bearish on that. That's why the survey is pointing to, the expectations of 6,400 to 6,800 in the S&P 500. In fact, we're seeing the recent downward drift in the U.S. equity markets as buying opportunity.
Christy, thank you so much. Let's talk again. Christy Tan, investment strategist at Franklin Templeton Institutes. The Chinese currency was rallying, and as you can see, dollar China is coming off lows a little bit right now. The initial leg lower was because of the PBOC line, which came through. The second part to the move might be down to a fix, which isn't as strong as expected at 1,500, but of course that is a fairly extreme expectation there. 14.24 is the spread to estimates. Counting down to the open of trade in Shanghai, in Shenzhen, and here in Hong Kong, the final session of the week, just 13 minutes away. Happy Friday. This is The China Show. Good morning.
The Financial Times says China will send a high-level envoy to Donald Trump's inauguration in a move to reduce friction with the new administration. Bloomberg News desk editor Jill Desis has more on this. Jill, just explain the significance. If we see someone more abnormal than what's usual, which is the ambassador.
Yes, Rebecca, I actually think this is quite a fascinating report because it kind of indicates that maybe China is taking Donald Trump's invitation to Xi Jinping the other month to his inauguration quite seriously, because historically Beijing usually just sends the China ambassador to Washington to these types of events, including the inauguration. We don't really see a whole lot of high-level officials there. So if they do send a more high-level delegation, somebody like Wang Yi, the foreign minister, it sounds like from the Financial Times report that the Trump administration is hoping it's someone even higher ranking like Tsai Chi. That's really Trump's right-hand man there. Not sure how realistic that is. But regardless, if we do get Wang Yi, if we do get somebody that is a little bit more high ranking than the ambassador, I do think that indicates that China really wants to kind of open up relations here, kind of renew relations with the Trump administration, try to better U.S.-China relations and get rid of those tensions. It's
a delicate balance. And I guess to your point, on one hand, the Chinese do want to take this seriously. On the other hand, they don't want to also be perceived as bending back to the wishes of Donald Trump, for example.
Yes, that's exactly right, David. And I think that's also why I think it would just be too risky for Xi Jinping himself to actually go to this type of ceremony. I mean, we've just seen Donald Trump within the last couple of months really rail against a bunch of leaders. I mean, he's, was trolling now outgoing Prime Minister of Canada, Justin Trudeau, saying, Canada's it should be the 51st state of the United States. I mean, the risk of Xi Jinping himself coming to Trump's inauguration and then sitting there in the audience, we're listening to Donald Trump sort of, criticize China. I think it's just way too risky for that to be some kind of an embarrassment to China that you would expect that, maybe, a lower level delegation, might be able to go and sort of weather that kind of criticism.
Jill, thank you so much. Jill Desis there in the studio here for us. Right, going into the open today, we haven't even gotten to many of these stories right now. Hang Seng Index, 0.5%. There is a trading debut today here in Hong Kong. Toymaker Bloks, of course, we're up 80%. There we go. First day of trade. More on this, plus the other market themes ahead of the Friday session. 8 minutes away. This is The China Show.
Welcome back. We are looking now at Bloks, this debut. Live pictures coming through shortly, or now in fact, at HKEX. Early trading of this toy maker. We saw really voracious demand coming out, sort of frenzied demand, particularly from the retail sector. A lot of mom and pop investors wanting to buy in. I suppose also partly a sort of familiar product that they're used to seeing. This is the producer of Ultraman, Transformer toys. So one metric of demand here showing that margin loans, this is, showing it was 6,000 times the number of shares available, Dave.
Yeah, I mean, they really kept money on the table here for, I guess, the retail market and the secondary market, part of the pun, to toy with going into the session today. But yeah, it does highlight, I guess, for one, the potential really for a really good optics coming into, you know, a market that isn't really firing on all cylinders, to be able to do this and price it properly.
Yeah, really interesting. I mean, relatively modest deal size, 250 million USD, but a real demand.
I think, was it 6,000? You mentioned 6,000 oversubscribed?
Yeah.
Okay. Well, we'll shelve that toy for now. We'll look at that a bit later on the show. I mean, other big stories that we're tracking here going into the open today, obviously the PBOC headline, which came through, that's number one. The Tencent, which continues to buy back a lot of its shares, another 4 million, I believe, that, on Thursday. JP Morgan call on Chinese markets to rebound. You had Goldman Sachs coming out with they've raised most of the Chinese banks to buy, raised some to neutral as well. And yeah, this yield story, which is picking up across the curve here. Rebecca, what else is top of mind for you going into the weekend?
Yeah, the other thing really is the TikTok story. We'll have these hearings on Friday in the Supreme Court on this potential ban that's due to come in January 19th. Trump, of course, has already made his feelings known. There should be a pause on proceedings. Yeah, so
that's another thing to counter there as well. And apart from that, there's also the Chinese developer story with, of course, Vancoas this week. We have Sunak China, which is another headline which came through. So yeah, plenty to sink our teeth in at the open. 3 minutes away. Happy Friday.
Welcome back. You're watching The China Show. We are counting down to the open of markets, and you're looking at live pictures from the Hong Kong exchange for that frenzied trading debut of this Toymaker Bloks, David.
Yeah, and if things go well enough, we'll be getting, of course, that banging of the proverbial gong or the literal gong in 20 seconds from now. Just an idea from my end, something that would really make this a lot more interesting too, is that they light up almost like an Olympic torch sort of effect there going into the ball. Anyway.
You want pyrotechnics?
Oh, who doesn't? Like, in the same way, everyone loves a good zoo. Anyway, let's have a listen. All right. 80% in the opening minutes, massively oversubscribed in the retail tranche of things. And I guess in some ways, if you are fairly fatigued going into the weekend, that in many ways marks the start of the weekend for you. There we go. We're looking at some marginal gains here in the CSI 300 going into the open today. JP Morgan, in case you missed that note, out of Wendy Liu and her team. So some downside short term with the dollar still on catching a bid. We'll get to the story on the PBOC in a moment, really on the other side of the trade. But they do see the inauguration and maybe some clarity around what Donald Trump really wants to do as potentially a trigger for a rally in Chinese markets in late January. More on the Goldman story and the Chinese bank story in a moment. Hong Kong open, please, if we can. We are on track still with, okay, I'm just doing some mental gymnastics here, 0.6%. We actually still should be poised for the worst week since mid-September. Tencent is finally catching a bit, 0.6%. They have been buying a lot of stock of late, I think 3 straight days almost. On Wednesday, 4 million shares. On Thursday, 4 million shares. The other Tencent story is going to show up on this next board. They've dropped their stake in Weimob from about, I think, north of 7% to 2%. That stock is now, 25%. There we go. The ETF story, which you see on your screens, that's listed onshore. Well, related to that story is, okay, I'm just racking my brain right now because I don't have my notes. So Invesco Great Wall halted its own ETF. It's not a Saudi ETF. They have an ETF that actually tracks S&P consumer goods. And there was also a separate JP Morgan fund. The underlying theme here is a lot of these sort of foreign-looking and foreign-centric ETFs and funds traded in Greater China are now trading at a massive premium to the underlying asset that some of them, like Invesco, have had to halt today. And we saw a similar dynamic back, I think, a few months back when the Nikkei 225, I think it was in October of 2023, when Japan was going all bonkers. In any case, Sunak China down 22%, and the story there, I think I do have notes for that. Bear with me. If not, my producers are about to help me out. Thank you so much. Receiving liquidation petition there, and Country Garden proposing and laying out the terms for restructuring. Okay, very quickly, Chinese banks, Goldman upgrade. First two on your screens getting an upgrade to buy. Bottom two on your screens, no. China Merchants Bank and Bank of China getting an upgrade to buy. Ag Bank and the rest, I believe, are back to neutral. The folks and friends at Goldman Sachs are going to pardon me there because I don't have my notes for this one. But yes, upgrading most of the Chinese banks from either sell to neutral or from neutral to buy. We'll leave that there for now. Rebecca.
Yes, so just recapping actually, in fact, you sort of touched on this a bit earlier, but some of this breaking news on the PBOC temporarily halting purchase of government bonds from the market. Meanwhile, in Chinese media, we also have the PBOC-backed financial news publishing a piece warning against betting too much on monetary easing. Quoting the global chief economist of Bank of China International, the paper says markets shouldn't overinterpret the central bank's moderately loose policy. The economist cites pressures on the yuan and warns of systemic financial risk from low interest rates affecting banks and institutional investors. Let's bring in Bloomberg Intelligence head of FX and rates strategy, Stephen Chu. Stephen, just to begin with some of that breaking news, the halt of purchases. We had our strategist Mark Cranfield on earlier saying this is a desperate measure from authorities. What's your take? And talk us through some of the sort of potential unintended consequences as well of this.
I think it's not really a surprise because like PBOC has actually met the bond traders, stopping them from buying. It didn't work. Yields still keep dropping towards record lows in 10 years, 30 years. So that's what they really had to do because basically this is QE. They've been doing this since August last year, basically, because nobody's picking up the CGBs. They have to step in. It's kind of like Japan. So now today they say they're going to temporarily stop it, meaning that they're going to come back, and they will have to come back. I mean, one reason why they want to stop that, of course, they want to support yields. They want to support the currency, just like what they did with the offshore bills yesterday. So it might work temporarily. We saw CGB yields rebounding this morning. We saw the currency rebounding right now, but it's not going to last. They will have to step back in later, just because nobody's buying the bonds. When we look at foreign investors, they've been fleeing the CGB market for 3 months in a row up to November, and they're not going to come back because yields are so low, and even if you get yield pickup after FX hedging, it's also dropping. So the PBOC will have to be there going forward.
Is there anything, and this goes back to one of the things you always point out, Stephen, that this record spread between the U.S. and where we are with China. I think we have a graphic which shows you the real one as a part of the nominal. I guess it also goes to the question, is there anything that you see as a potential catalyst that might lead to a weaker U.S. dollar over the next few weeks?
I mean, like, if we have a more mellow Donald Trump, of course, if there's no trade war, he just retract everything he said, so basically no tariff, no tension, and of course the dollar may drop. But everybody knows what's the odds of that, I can't really tell. And apart from that, a more dovish Fed. If the U.S. data weakens massively, like job data, for example, inflation data, then the Fed could be afford to cut faster. But again, we can see the data is actually quite stubborn and resilient. So that's, again, a very low odd of the dollar crashing, basically.
There we go. Stephen Chu, of course, highlighting, and I guess the other point we want to make is the jobs report is coming out later today, and something really that the PBOC is really indirectly having to deal with as a side effect and a headache there. The other story we're tracking right now, I'm just looking at my screen, is 68% to the upside on Bloks. That's the trading debut today. Believe it or not, we're coming off highs of the day at these levels. Let's bring in Julia Fioretti here to talk us through. Why don't we talk about this deal specifically and what it might mean broadly speaking? As a good start to the year.
It is a good start to the year, but it is quite a peculiar deal in the sense that it was sold cheaply, relatively cheaply, and that drew some of the demand, obviously. In terms of the retail, which was massively oversubscribed, I think the oversubscription was about almost 6,000 times the number of shares initially made available to retail. That was driven by low or even zero interest rate margin loans. Obviously, it was extremely easy for retail investors to get funding to apply for the IPO. There is also an element of consumer being a big theme for IPOs in Hong Kong this year. Whilst obviously the Chinese consumer sentiment isn't great, lower-end sectors such as this, for example, will do well. They are also more insulated from the geopolitical tensions in terms of with the US.
And talk to us a little bit about this IPO divergence that we've seen, something of a recovery last year, but what are you expecting going into next year? What are some of the sectors that may, as you say, be somewhat more favoured?
So consumer is obviously one, because it is relatively insulated from geopolitics. Another one, it's not really a sector, but a theme that we're seeing is the A to H listing, so mainline traded companies coming to Hong Kong. Most of the pipeline, or most of the big deals in the pipeline, rather, are such listings. We've seen CATL has announced that they're looking to do one, Hengrui Pharmaceuticals, and these are easier deals to do in these sorts of markets which haven't fully recovered because there's already a listed benchmark, essentially, to set the valuation, and it's just about pricing it at a discount to those shares. So we're still waiting to see the full recovery of the IPO market, and there aren't really any firm expectations for that to come, at least in the first half of this year.
Julia, thank you so much. Julia Fioretti there on this massive deal. As you can see, good first day at school, 67% to the upside. All right, breaking news. And you know what? I didn't get too much good sleep last night. I went for a long run, so that sleep is wanting. And I'm not ready for a day like today, to be honest. But in any case, of course, the PBOC and the FX regulator, SAFE, will be holding a briefing on financial support for the economy. Not today. A date is set January 14th. So I'm looking at my calendar. That's Tuesday next week. And we're looking at some individuals that they've lined up now who are set to join that briefing. You have the deputy governor and also the deputy chief are set to speak. What also might be critical here is what time, and we don't know what time yet, what time they'll actually be holding this. And certainly we've seen, Rebecca, from a timing perspective, if it's at 10 a.m., which is sort of the usual, whereas suppose if it's 9 a.m., which is the initial briefing that really sparked things up. So lots of details, but again, it might spur speculation about what else they could announce.
Yeah, and just worth bearing in mind the context it's all coming in. Of course, we had that relatively disappointing deflation data, inflation data coming through, suggesting China, again, still teetering on the edge of deflation, really struggling to pull itself out there, which has been challenging. And the other thing also, more details on this expanded consumption trade-in program, and that really didn't sort of seem to capture the imagination of investors. So it's been a difficult week, despite actually some quite proactive measures by authorities trying to improve the economy and kind of spur a little bit of optimism.
I mean, such as this, right? Yeah. You know, investors have been trying to grapple with, in the absence of an improving economy still yet, or earnings, right? You get pronouncements like this that might be able to tide us over. We now have I'm just looking at the notice here. So top of the page is in Chinese, the bottom, okay, I'm just talking to myself now. So 3 p.m. is the time set for that briefing, so mark your calendars now. Tuesday. Next.
Yeah. Okay, elsewhere, looking to another part of the world coming up, we have almost 180,000 people forced from their homes by the Los Angeles wildfires as President Biden fast-tracks federal aid. We'll have an update on that story next. This is Bloomberg. Now, President Biden says the U.S. government will cover 100% of the costs of the California wildfires for 180 days, calling the devastation catastrophic. Let's take a listen.
So today I'm announcing that the federal government will cover 100% of the cost for 180 days. This is going to pay for things like debris and hazard material removal, temporary shelters, first responders' salaries, and all necessary measures to protect life and property.
Let's bring in ABC News correspondent Alex Stone, live from the fire zone in Altadena, California now. Alex, just bring us up to speed on, the extent and the severity of what we've seen so far and what we're expecting to see overnight where you are.
David and Rebecca, hello to you. The numbers continue to go up in all ways. The acreage has gone up. The Pacific Palisades fire now nearing 20,000 acres. This one over 10,000 acres here in Altadena near Pasadena, east of where the Pacific Palisades fire is burning. The number of dead has now gone up to 7. 5 on this fire, 2 more who are confirmed dead on the Pacific Palisades fire. But the problem is they really don't know what the number is. They've got to get cadaver dogs in now to begin going through what's left of the buildings. Like this one behind me, this was a chiropractor's office, and this is all that remains. It is like this home after home after home, building after building, where everything is burned down to the ground, and they don't know who was in these buildings, so they've got to bring those cadaver dogs in. Unfortunately, the winds are expected to, tonight, pick up again, another Santa Ana wind event. The National Weather Service is saying it could be a strong Santa Ana wind event that could blow the flames. There is a new wildfire that has broken out in the West Hills area of L.A. That has caused evacuations. There are engines that are running in from nearby Ventura County to try to deal with that. There are just so many fires. A lot of help is arriving here right now, but so many fires that are burning.
Alex, David here, you mentioned, excuse me, evacuations. I wonder if you could give us an idea currently of the specific areas in and around where you are, where perhaps people are being asked to either leave their homes or have recently left their homes.
Yeah, David, they're being told they've got to go. There's about, I believe the number is now at 150,000 people who are under evacuation orders. And they have been told to leave their areas and to go to hotels or just get out of the region at this point, or at least the local area where the fires are burning. So people have gotten out. Now, mandatory evacuation under California law, they're not going to drag people out. So there are some who have decided not to go. But the way it works is once you go, you don't come back in. So many of those people have left. There are still some who have decided that they want to stick around and that they're not going to evacuate. So there are still some homeowners who are kind of roaming around, but it's a large group that has been evacuated from this fire and from the other fires that are burning, not just Pacific Palisades. That's a huge number as well, but the fire that just started in West Hills and the other fires that have been burning, a lot of people have been evacuated.
ABC News correspondent there, Alex Stone. Keep safe, of course, to you and your team at Altadena, from Altadena, California there. And you can turn to your Bloomberg, by the way, here for more on this. TLIV Go to get commentary, context, analysis, and really the latest on this ongoing, of course, tragedy that's taking place there.
Right. To our other major headlines now, the U.S. Supreme Court has cleared the way for President-elect Donald Trump's sentencing on Friday in his hush money criminal case. In a 5-4 decision, the court rejected Trump's request to halt the New York sentencing, while the state appeals court considers his claim of presidential immunity. The judges said the burden on Trump would be relatively insubstantial since no prison time is expected. Lebanese lawmakers have elected Army Commander Joseph Aoun as the country's first president in over 2 years. His win is seen as a sign of Iran's waning influence in the region and a pivot towards the West. Aoun begins a 6-year term facing a crippling economic crisis while helping maintain a fragile truce between Israel and Hezbollah. And a Venezuelan opposition leader, Maria Corina Machado, has been briefly detained following a protest against President Nicolas Maduro's planned inauguration. He's due to be sworn in for a third term on Friday after claiming victory in last year's disputed election. One of Maduro's closest allies, the Colombian president Gustavo Petro, will skip the inauguration due to a series of arrests of opposition figures. There is plenty more ahead. Stick with us. This is Bloomberg.
Welcome back. You're watching the China Show. We showed you the chart earlier on. Here's the Hong Kong dollar as one of the iterations of that chart. This sharp divergence in bond yields. In fact, on a real basis, the spread is 1 percentage point. That's something that we've never actually seen between dollar rates and where you are with the rest of the world, right? What that means, it's a stronger dollar. What does it mean for the peg? Here we are again with this discussion. Shuli Ren, our Bloomberg Opinion columnist, is here to talk us through her argument that this 4-decade currency setting might make less sense currently, and why is that?
Well, I just want to say the Hong Kong Monetary Authority put out a statement yesterday afternoon saying that they have no plan or no need to remove the dollar peg. And it just shows how much, and even though the Hong Kong dollar is trading at the strong end of its narrow trading band, and it just shows how much market dissent there is on the usefulness of this dollar peg, right? Otherwise, they wouldn't put out this statement. And some people are arguing that, look at Hong Kong's rise in the last 20 years. It was part of the rise of China's economy, but part of it is Hong Kong's role as the go-to fundraising center in Asia. And now it's pretty clear that the cheap cost of funding has shifted from the US and Japan to basically China, right? We know the China government bond yield is going to go to sub 1% or even zero rate, perhaps 5 to 10 years down the road. And why are we still sticking with a funding currency that's kind of quite expensive, to be honest? I mean, just look at concrete examples. Neural Development, a blue chip Hong Kong developer, they've been issuing Yuan bonds onshore because the cost of borrowing is just so much lower, 3.1% for a 12-year bond, for a 12-year loan versus, say, 5 to 6% for Hong Kong dollar-based loans. And then look at the property market, right? Right now in the commercial, in the residential real estate, we still have negative carry, and the mortgage rate is higher than rental yield. And in the retail space, we know all the Hong Kongers are going to Shenzhen to shop. So unless the cost of borrowing comes down, I just don't see how we can, our property market can bottom. So I just think, anything runs out of its usefulness, and the dollar peg is 41-year-old, and at least we should have a discussion on what we should do going forward.
Yeah, really a live debate, so as you're saying, caveating with that HKMA statement that they are not looking to swerve. But just talk us through, theoretically, what a transition might look like, how disruptive it would be.
So I think, first of all, if Hong Kong was going to do anything, it should be our own terms. It shouldn't be at the threat of Kyle Bass or Bill Ackman, for instance, right? Because if we depeg on the weekend, there will be more speculative trades, and it will be quite chaotic. And secondly, I still think the Hong Kong dollar is still too dominant in this economy, and we don't have enough yuan being in the system. Like, for instance, if we look at Macau, right? Like, when you go to Macau, you can easily use the Hong Kong dollar or Chinese yuan, no problem. But the yuan is not being circulated enough in our economy.
Shuli, thank you. Bloomberg Opinion columnist Shuli Ren there. Now, here are some of the stories we are following today. Millennium Management's hedge fund spin-off is planning to expand to Hong Kong. Sources say Singapore-based Modular Asset Management is looking to open an office in the second quarter and has brought in a Barclays trader as its first hire. Hong Kong is trying to defend its status as a global financial hub while coming under pressure from China's economic slowdown and geopolitical spats. Executives at top Wall Street banks are said to be locking in plans to award traders and deal makers their biggest bonus increases since the pandemic. People briefed on the plans say bonuses at B of A will rise an average of 10%, with similar increases expected for traders at Morgan Stanley and JP Morgan. We're told Goldman Sachs bonus hikes will go even further at some of its trading desks. Spokespeople for all the banks declined to comment there.
Yep, I guess we'll have to wait for March then for the bonuses to really see what they come in at. But yeah, I know a lot of people are already counting their eggs. Okay, the yield story on the CGB in the CGB space is really, and as you can see, by the way, just a caveat too, and for context, you know, the moves you're seeing on your screens, 3 basis points in the 10, 6 basis points in the 5-year yield. You don't see moves these big typically in the CGB market, right? You get 1 to 2 basis points here and there. So this really tells you what sort of busy last few minutes and last hour has really been because of what the PBOC's done, talking about how bond operations here and that they may be looking to resume that. We'll unpack the story later on. Lots of good conversations coming up as you see on your screens. This is Bloomberg. Welcome to the program. You're watching the second hour. We're entering the second hour of the China show. Hope you're all well. Can't wait for the weekend. I actually thought, honestly, it was going to be a quiet Friday, but certainly not the case. Yeah, the PBOC headlines coming through. I honestly thought we were just going to be talking about the job support and then gliding into the weekend, but yet here we are. By the way, we're still in the window to get the December credit numbers coming out of mainland China, which typically we're in the window for that. They typically come, not all the time, but I would imagine, I won't be surprised if they come happy hour on Friday, which is typically when they drop on my phone while I'm holding a warm glass of milk. Let's bring in Annabelle Droulers, our co-anchor for the rest of this hour, to talk us through what is top of mind for you as you, with that big grin you have on your face.
Well, I'm just laughing at your glass of milk, I'm sure.
Oat milk, to be more specific.
Okay, all right. Aside from Dave's glass of milk later today, but what also really tracking, I think, of course, yeah, it's been the PBOC story, so it's bonds, and then there's also blocks. That's been an interesting story the last half hour or so, jumping more than 80% in its debut. But here you're actually taking a look at what's happening in CGBs this morning, and they have been reacting to this PBOC story. So looking to get out of the market, essentially pause their buying for seemingly an unspecified period of time. But you have seen that reaction of yields just moving higher.
Yeah, Mark Cranfield from our MLive team described this as a desperation move short term to really, I think, temporarily put a stop to this downward move in CGB yields. And I think what's interesting here, too, is you have two things that might have gone unnoticed by most investors. Number one is the Financial News, which is the PBOC-backed newspaper, actually put out a report pushing back against the notion, do not overinterpret that shift in monetary policy. Might have to do with temporary expectations, right? You did see, I think, the swaps curve in China flip into the negative, which might indicate markets are sort of repricing their expectations of how big or how early that stimulus might come. The other one, too, which took place, I'm not sure if you saw the headline, Bell, that on Tuesday, the PBOC and SAFE announced that they'll be holding a briefing at 3 p.m., I believe, on Tuesday. So that announcement came about 30 minutes back. But yes, among many
it
things.
starts to kind of look like messaging on messaging on messaging, and it's really difficult to determine sort of the underlying...
Yeah, like what are you saying?
Yes, mixed messages, to say the least. But taking a look at what's happening in equities this morning, because Wall Street was shut overnight. We had the funeral for former President Jimmy Carter, but the story today is really very much equities that are under pressure. And playing into that dynamic, of course, is what we're seeing in the bond space and the move higher in Treasury yields. You get moves in the dollar, and that's a negative for Asia in general. So that's what we see there for equities. But you're tracking as well what's happening in more currencies.
Yeah, I mean, the dollar has been, I think this is, new year, but old story, 14 weeks of gains in the last 15. We're at 109. Don't be surprised if we get 110 on the dollar spot. 2-year yield, as Bell was pointing out, up across the curve, and we're now at 4 26 ahead of the jobs reports on the back of some commentary coming out of the Fed. Of course, cable was very much in focus at these levels. You're at 2023 levels there on cable. Speaking of the Fed, we did hear from Patrick Harker, of course, out of the Philly Fed, and of course, Michelle Baumann, a Fed governor there as well, on their outlooks on policy for the coming year. Have a look.
I still see us on a downward policy rate path. Looking at everything before me now, I'm not about to walk off this path or turn around. But the exact speed I continue to go along this path will be fully dependent upon the incoming data. We can stay where we are for a little bit, probably not long, but we'll see.
We must be clear in our communication about how further changes are intended to affect economic conditions. We should also refrain from prejudging the incoming administration's future policies. Instead, we should wait for more clarity and then seek to understand the effects on economic activity, the labor market, and inflation.
Okay, and this really highlights the U.S. exceptionalism theme, and we're juxtaposing this really on two charts with the China story and a yield spread, which, the premium of dollar yields, as you can see, the highest in a generation at the very least against the Chinese counterpart. And on the equity side of things, the S&P 500 is trading at 22 times. China's trading at 9 times. That's a record, well, not really a record premium, almost a record premium, nearly 60% more expensive in the U.S. when it comes to the equity market. So the question really here, I guess in one sense, is are markets overly optimistic on the U.S. or overly pessimistic on China? Somewhere in between, but to help us understand really where market thinking is right now, Karsten Junius is here with us here on set, Chief Economist and Head of Economic and Strategy Research at Bank J. Safra Sarasin. Nice to see you.
Yeah, good to be back. Yeah, hello.
Among the many things I might lose sleep over this weekend, whether that's higher yields, a Fed that's not moving, the lack of inflation in China, what do you think I should be most worried about?
Well, I think it's clearly the increase in yields that we have seen in the last few weeks that is going up to levels that at some point will become a problem. First, for equity markets, I think that is something we haven't seen sufficiently so far. They are not reacting as much as I think they should. Well, and the second thing is that high yields are an important constraint for fiscal policy. So they become a problem I think we see it in the UK right now. We might see it in some European smaller countries. At some point we might also see this in the US, which of course would be our most important concern.
Why do you think investors are ignoring this so much?
Well, I'm not really sure whether they're ignoring the risk. That is the risk also reflect that we don't really know what is going on with policymaking in the US. But you mean equity investors, I guess? Yeah,
equity investors. I mean, like yields moving higher. Do you think that people are sort of perceiving that maybe as a short-term shift, and that story of, going back to last year, but we had just that 7 cuts baked in, and of course we've moved away from that, but that general exception still persists, that we are going to see easing.
And just to add to that too, right, if yields are at these levels where it might become very problematic, why is a measure like the VIX, for example, not as high as perhaps where we would normally imagine it to be?
I'm looking at this every single day. I'm expecting the VIX to increase, and I'm sure at some point it will. But coming back to your question, I think at this point investors still discuss the origin, the reasons for this increase in bond yields. And there are actually two that we cannot really distinguish. One is the fiscal outlook and the uncertainty where the markets can actually digest those increases in debt levels that we might see in some countries. And the other reason is the strength of the U.S. economy. And quarter after quarter, we have to acknowledge that growth is stronger and not really coming down. So small businesses are getting more optimistic right now. Households are getting more optimistic. So we will not have only had a fourth quarter in the U.S. that will have delivered solid growth, but also the first quarter is going to be strong. And with that, we know earnings growth of U.S. companies that is exceptional already is going to continue.
Do you think the next move of the Fed should actually be a rate hike instead of a cut?
Well, officially, we still forecast 2 rate cuts.
Okay, but what do you really think?
But the risks are clear. Actually, those quotes that you just showed in the show, I think they highlight so nicely that also the Fed doesn't know what is going to happen in the second quarter of next year. And so frank about this, that they need to watch the data as much as we do. So we're kind of all on the same level. And that is kind of reassuring to know.
But, I mean, do we see a cut this year at all, do you think?
Well, we should acknowledge that there's a soft landing in the labor market. So rate cuts in general are something that is justified. The inflationary pressure that we had 1.5 years ago was much higher, and therefore it was justified that we had these elevated rate levels, and that it's also justified that with a more normal labor market that is kind of in equilibrium. When I look at the ratio of vacancies to unemployment, for example, we are back to a level of 1 to 1, having been at 2 vacancy per each unemployed person just, 18 months ago. So there's a soft landing, and with a soft landing, it's justified that the Fed moves closer towards a neutral territory, wherever that might be. I guess it is still a bit higher. So default would be that the next rate change should be the next cut should be a cut. Yes.
Right. Okay.
But we also don't know actually what kind of policies we are getting. We don't know really what the fiscal policy will be in the future. We don't know whether tariffs come or not, and we definitely should be prepared for everything.
I mean, the way you describe it almost seems as if the risks are not exactly binary, but the level of uncertainty out there over what the next 12 months or what the economy looks like in 12 months' time suggests. Is that why you think there's money piling back into cash? Is that why you think the term premium is where it is, for example? What explains those very extreme measures in markets we're seeing these days?
So I think the most important thing is the increase in term premium, because that is reflecting the uncertainty that we all face right now. We are far away from this period where we receive forward guidance from central banks that actually had the deliberate effect to lower term premia in markets. And now we are going back to a period where first we don't know what the economy is doing, and second, we don't know what policymakers are doing. And financial markets will have to deal with that. There's one positive thing there I would like to mention about all that. I also believe that there's a feedback loop from financial markets to policy making. We only talk about the other way normally, that financial markets reflect what might come out of Washington. But I strongly believe that all policymakers also look at financial market, and that's definitely something that will constrain them. So if we have a 10% drop in the S&P, well, we definitely get less awkward news on the tariffs front. If we have a strong increase in bond yields in Europe, we definitely get a more prudent fiscal policy by national governments over there. And if real estate prices fall over here, we might also get a policy reaction. And I find this kind of reassuring that we actually look in both directions.
All right, markets and policymakers have something to learn from each other. Well, you're staying with us, Karsten, Junius there from Bank J, Safra, Sarasin, and still ahead on the China show, we're going to be speaking to digital payments platform Dash, joining us to discuss their business strategy and the push for cashless taxis in Hong Kong. I know there's a lot of people in the city that wish they could pay sometimes for their taxi without just needing to have cash in their wallet. But more ahead. This is Bloomberg.
Okay, cash markets are looking like this. We're at 45 minutes into the cash market session. Hang Seng Index, CSI 300, as you can see. I mean, we were up as much as 1%, in fact, on the Hang Seng Tech Index. So that's a story for Asia. We're looking ahead, of course, to the jobs report. We're looking at U.S. futures. European futures also should be coming up on your screens. This whole question around euro parity is back in vogue, isn't it? So I guess in many ways it's an iteration of the strong dollar story, Bell, and really what opportunities lie beyond, I guess, an expensive U.S. market and maybe a lot of uncertainty around some of these assets here in the Asia-Pacific.
Well, that leaves really one major region. And we can get more details on that now. We're back with Karsten, Junius, Chief Economist and Head of Economic and Strategy Research at Bank J. Safra, Sarasin. We were just talking there in the ad break about you've been with this bank now for 10 years meeting clients in Asia, but this trip is the first time that you're actually getting questions about Europe and investing there.
Absolutely. I'm so surprised about this because I always told focus on China, focus on the U.S. economy when talking to clients over here. And really, this time, they are looking at Europe for a very simple reason. Europe is cheap. In the equity market, definitely, but also in the bond market compared to other countries. So specifically, clients are worried that valuations are just too high in the U.S. They are worried about the bond market over there, about fiscal policy over there. We just talked about all that. They're kind of pessimistic about China, so still don't seeing a rebound and looking for areas to invest. Outside those reasons, on top of gold investment that everyone likes after last year's rally. And I think in Europe they find cheaper valuations. No, growth is not exciting over there, but that really is factored into market prices. Now, looking ahead, the full year, we might still get some disappointing data in the first half of the year, but that will also trigger rate cuts by the European Central Bank. So the ECB will be one of the central banks that is definitely cutting more than everyone else, and that, I believe, should stimulate a nice rebound for the second half of the year.
How many cuts do you think the ECB has in its pocket this year? And the other part of the question is, do you think that will then lead to, we're going to show the euro, the currency in a moment, do we actually fall below parity against the dollar?
Well, I kind of think that the short-term the US dollar is a bit overbought.
Okay.
But definitely we are heading towards parity. That is at least quite likely at some point during this year. Whether that is a durable thing is another thing, because at some point I said I also would rather see a Fed cut than a Fed hike. But short term, for let's say for the next few months, the interest rate differential should widen. I actually see 4 rate cuts in the first half of the year in Europe, and then another rate cut in September or so. So interest rates are actually will be extremely low compared to the US, and that will definitely weigh on the euro, but not necessarily on European equities. So we are getting 2 factors over here: a cheaper euro and lower interest rates, on top of the low valuation that we already have in equity markets. We can compare PEs in Europe with the US, and then everyone is saying, hey, you can't compare them because you have such a large tech sector in the US. But then you can also compare sector by sector in equity markets. And almost each sector, I think, except for utilities and tech, we see lower valuations in Europe than in the US. And I think, well, the risks and opportunities that are derived from that are clear.
I think we're trading at 13, 14 times on the European benchmark on a PE basis. But yeah, talk us through.
About over than 20 in the
Well, what's the specific recommendation then? So if it's not an index play, what's the most compelling recommendation you can give these clients?
Well, healthcare is something that we like in the current circumstances, simply because it's a defensive play, it's undervalued, and well, should show a nice rebound.
Last question on China, and you mentioned obviously there's pessimism around it, but as you point out in your notes, really that we've seen a decreased reliance on the US and maybe even Europe, for instance, from China. It's really that play for the global south now.
Yeah.
Do you think that the narrative sort of around China and the external challenges it's facing starts to shift this year and there's a greater appreciation of those new trading relationships?
Well, definitely there will be. That is China's chance. So besides maybe reviving the domestic economy, but that is difficult enough. So they need to go out. They need to export to the global south. And actually, that is the biggest worry that we have over there in Europe, that we cannot compete with China in those markets anymore.
It's very nice to see you. Let's do this again next time you're back in town. The chief economist and head of economic and strategy research at Bank J. Safra Sarasin. Okay, we're going into just a very short break. On the other side of this, a lot of movers to tell you about. Plus, of course, the Japanese lunch break is about 10 minutes away. So if you want to get ahead of the crowd, just rush to the elevator right now. Why not? Early lunch break for you guys. Happy Friday.
Welcome back. Here are some of the big corporate stories that we're tracking this morning. And defaulted Chinese developer Country Garden has proposed new terms with key banks that would slash its debt and lower borrowing costs. The company says the proposal would help it achieve significant deleveraging with a targeted debt reduction of almost $12 billion. It also proposed a debt maturity extension and asked for a reduction in funding costs. And another defaulted builder, Sunac China, has received a liquidation petition in Hong Kong. The city's judiciary website shows a winding up petition filed by China Sindra HK Asset Management with a hearing scheduled for March 19. The case signals renewed financial and legal stress for the Chinese developer, which first defaulted on a dollar bond in 2022. TCS reported quarterly profit and revenue that missed analyst estimates, signalling overseas clients are still cautious in betting big on IT projects. Net income rose 12% to $1.4 billion in the 3 months through December. India's leading software services provider says it expects this year to be better as clients spend more and deal cycles shorten. And we'll speak with the TCS CEO and MD about the earnings outlook and the result as well, of course, on today's edition of Insight, coming up at the Times on your screen.
Yeah, watch out for that coming through, of course. Just very quickly, as we go through some of the big movers to tell you about here, so 69% right now is where we currently are on this Chinese Toymakers trading debut in Hong Kong. Of course, just keep in mind, just give you a little bit of numbers here. The IPO price was at about 60. We opened substantially higher at about 109, closer to 110. As you can see, we pared back about $7 from the top, but we're up, 41, 42 from the actual IPO price. Other things to tell you about, Sue, so we have fast retailing going into the Japanese lunch break. Nippon Steel, of course, which has been in the news. Fast retailing is, just very quickly, this is a... this is based on reports and not just from the company itself here, that when you look at the Chinese market, it's everything but that market that is presenting some strong growth. We're up 6.5%, we're down 6.5% rather in fast retailing going into the lunch break over in Tokyo. Now, I can tell you, though, that I was in, giving away where I was in Japan, actually, there we go, a couple of weeks back, and I can tell you, fast retailing stores, whether that's, I don't know how to pronounce it, is it GU or GU? And Uniqlo were heaving with people. Like I almost saw it for once. I was in a nightclub right now, just showing how I couldn't, there was no space to walk.
Was it locals or tourists out of interest?
That's a good question. I don't see race. What I do see is opportunity when I look at that. But I can tell you, though, there was, and you really see, taking a step back, right? You know how the Japanese have really embraced the weaker Japanese currency from a tourism perspective, right? You had two separate cashiers where you had sort of the tax-free line because you're exempt from the tax, of course, and you have, of course, and a lot of people were lining up, of course, on the side of the tax-free conversation.
Okay, so you don't see race, but you do see queue length.
Yeah, or cheap jeans.
All of those things that you see.
They're very good down jackets, I have to tell you that too. Very good down jacket. For the price, yeah, I would never spend whatever amount for whatever these very expensive ski jackets you see in Hong Kong. I think they're robbing you really of that. The cheaper stuff keeps you warm enough and you can sleep at night because you know you didn't burn money. But anyway, that's a personal perception.
Glad we got that out in the final few seconds. More after the break. It's 11:29 a.m. in Tokyo. Japanese markets just about to go into their lunch break, and it's been a third straight session of losses this week for the Nikkei 225. Earnings are playing into the picture, and we've had a couple of numbers coming out. So fast retailing is one we were just discussing. They've got pretty good sales everywhere except for China. And then as well, 7 and I shares, they've been dropping because there's been a third quarter sort of lacking some clarity on what exactly is happening with the possible MBO there. So that's Japanese markets. And what are you watching, Dave?
I'm watching the stronger dollar and the fact that on the Asia-Pacific benchmark, bottom of your screens, and a sector breakdown is coming up on your screens very shortly. A third day of losses in the equity markets here in the Asia-Pacific. We're looking ahead to the jobs report, which probably will remind us of why the dollar is strong and where it is right now. Although, at least for today, as you can see on your screens, bottom row, second from the right, the Bloomberg Asia Dollar Index is slightly to the upside. So you are getting some buying going into the thick of the Friday session. A lot of this has to do with maybe the PBOC coming in with yields up and a stronger currency, Chinese currency, leading to roughly a broad but modest bid across Asia FX going into the weekend, Bill.
All right, something else happening this weekend. The UK Chancellor of the Exchequer, Rachel Reeves, is visiting China in a bid to deepen economic ties. Let's get more with China government reporter Colin Murphy in Beijing. And Colin, we haven't seen a British official of this seniority in visiting China for several years now. So how significant is this visit, and also what's on the schedule?
Right, so yeah, 7 years actually since a cabinet member or a politician of this sort of seniority has visited China. It's a 2-day visit, and it's Beijing and Shanghai. She will be accompanied by some other folks as well, including the Bank of England governor, and as well as some financial regulators from the UK and some participants from the banking community, including, we understand, HSBC and Standard Chartered. On the agenda will, of course, be how to deepen and even to an extent reset ties between the UK and China. The British side will be looking to expand economic opportunities and also to deepen financial ties between the two countries.
Colin, what's China's view on this? And I guess in terms of managing expectations, what sort of outcomes can and should we, maybe two separate words, two separate questions, what should we expect?
Right. So the Chinese are, quite happy to look at countries like the UK, who perhaps at this time, are looking at the inauguration of Trump just very much immediately, 10 days from now, and perhaps thinking of ways to sort of hedge their economic futures, if you will. So the Chinese are happy to take full opportunity of this sort of situation, and they have been engaging with countries, not just the UK, but also Japan, India, and even Australia in recent weeks. So that's what the Chinese are looking for. In terms of outcomes, I think we can say that this is building on existing frameworks that have been in place between the UK and China for many years now. So we can actually expect some tangible results, particularly in the financial area, maybe something in relation to bilateral dialogue on capital markets, but also other areas in trade and also the environment, of course, wind, solar power, etc. So, they are playing down expectations. We're not really hearing that much from the UK side in terms of what can be the outcome, but it might end up pleasantly surprised by some of the announcements tomorrow.
Yeah, also be interesting if Xi'an comes up as a talking point as well in those discussions. But do you think that this is sort of the start of more regular meetings moving forward?
Right, I do. And insofar as our reporting shows that, the UK side is hoping to make a visit by Reeves like a regular thing, perhaps twice a year even, that would be at a par with, say, the likes of Janet Yellen. But the backdrop, of course, is that in the UK there are a lot of issues to be handled domestically as well, including those relating to China. So we've had allegations of cyber attacks, we've had spying allegations as well. So the domestic UK environment vis-a-vis China is still in flux. So it really depends on a combination of these domestic factors plus the China side openness to continue these meetings.
All right, Colin, thank you so much. Colin Murphy there, our Bloomberg reporter in Beijing for us. Now, to some of the other geopolitical headlines and stories we're tracking this Friday, let's start things off in Japan here. So you have the ruling Democratic Party has issued this resolution, or a resolution, calling on Tokyo to take concrete action against President Biden's decision to block Nippon Steel from buying U.S. steel. Now, the party says this includes a reversal of the decision and specific explanations of the security concerns behind the U.S. rejection. Now, Texas is suing TikTok for labeling its app as safe for minors despite allegedly presenting them, of course, with sexual content. Here, the suit seeks more than $1 million in penalties and fees. It comes just as TikTok, and this is the big one to watch, of course, going into today, set to appear before the Supreme Court in a last-ditch bid to avert a ban, which is, well, due to come into force in about 9 days or so.
Yeah, and as you said, that is really the key question here as to what's the stance that they take in this hearing later today. We know that the top court is going to be holding oral arguments to discuss this, but as you said, it's really coming up against that timeline. We're just 9 days out now from TikTok possibly forcing a ban or facing a ban unless it divests its app. But I mean, of course, it's that question as well, how would China respond to this? Would they likely block any sort of sale? Who would be the sort of suitors as well? These are all lots of different questions. But I was actually just speaking with someone earlier today who works with a lot of companies that are looking to take their businesses outside of China. And we were talking about TikTok in particular, and he said that this is going to be really the big litmus test now.
Yeah.
Any Chinese company that's looking to expand their presence, they want to know exactly how Trump treats this in his early days in office, and then take that as sort of an example of really where the ties are going to go over the next 4 years.
And I think that's interesting because to your point, we know what Donald Trump has asked for, which is to delay this decision. And when it gets to the Supreme Court, and one could take the view and say the Supreme Court, and you see a lot of the nominations by Donald Trump onto the court. The other thing, the legal conversation here is it's a First Amendment conversation against, of course, national security. And which side of that extreme will the pendulum swing as far as the voting goes here? To your point, the oral argument, something to look ahead to here, Belle, going into this, I guess, to your point, a very important acid test for these conversations.
And we'll have all of that recap, of course, I guess on Monday. But we will be definitely watching that later Friday in the US. But taking a look now at what's making headlines in China's national newspapers. And the PBOC-backed Financial News has published a piece warning against betting too much on monetary easing. You were talking about this earlier, Dave. But quoting the global chief economist of Bank of China International, the paper says markets shouldn't overinterpret the central bank's moderately loose policy. The economist cites pressures on the yuan and warns of systemic financial risk from low interest rates affecting banks and institutional investors. Meanwhile, we're seeing more measures to boost consumption. Shanghai Securities News reports that more than 10 provinces, including Jiangsu, Zhejiang, Fujian and Guangdong, are launching consumption vouchers in time for the Spring Festival. Some of the provinces are issuing coupons for new and second-hand car purchases, as well as food and supermarket vouchers.
Meanwhile, here's something you won't see on Chinese media or social media platforms here. The death of a teenager reportedly sparking violent protests in the Shanxi province. That's according to the BBC. Let's bring in Rebecca, of course, here with us on set to talk us through what we know about these protests, of course, that we've seen some pictures of them as well.
Yeah, so far. I mean, really centered around a very tragic case of the death of a teenage boy at a school, boarding school in China. And this incident actually happened at the beginning of the year. And since then, we've seen a lot of videos circulating online of protests reacting essentially over allegations and mistrust in the explanation from the school and from authorities. So we did have a statement that the BBC reported from local authorities explaining this, saying essentially the student appeared to have fallen from a great height, that his body was later discovered, and that the police are not opening any kind of criminal investigation. Now, that explanation has really been sort of called into question. There are discussions over bullying and so on. That's sort of unverified online. But the BBC has sort of verified some of this video footage. We also have the think tank China Dissent Monitor looking and documenting some of the footage on these protests. Relatively large scale. Protests in China isn't particularly uncommon, but I will note the scale of some of these protests is quite large. You can see some kind of confrontations with the police and with the authorities there. Worth saying that when the BBC asked local authorities about this, they said there were no protests that were happening.
Yeah, and so, I mean, you mentioned, the scale of the protests, and also, maybe we're starting to see more protests, is that right, in China?
Yeah, so, I mean, data on this, as you can understand, is incredibly sensitive in China. They stopped collecting it quite some years ago publicly. But, China Dissent Monitor and other databases do show that there have been more protests, particularly through the latter half of last year, and particularly in relation to economic grievances. But these sort of cases around, mistrust of school authorities, bullying and deaths in China of young students is not actually new. We have seen these sort of similar incidents cropping up last year. Particularly sort of very, of course, as you understand, very local issues, but of course, deeply, deeply emotive. Now, more broadly, we see this sort of sense of social malaise, economic discontentedness coming through much more through the second half of last year too, sort of a record bump according to one database before that stimulus. So much so that the likes of Morgan Stanley and other economists and strategists really looking at protest data as an indicator or a driver of stimulus moves in China.
Just to pivot to, but staying, I guess, in terms of just how things are being viewed, the earthquake that took place, of course, very, very strong one. How is Chinese media looking at this?
Yeah, this is another story that sort of dominated unofficial media for this. Really, we saw a very swift response from authorities, both public and actually sort of on the ground there, trying to roll out a response. It's interesting to see Chinese media very much using this as an example to promote, the services and the very swift services that Chinese authorities provide to its people. Now, Tibet, which China calls Xizang, has been sort of the topic of a lot of stories, including with Global Times editorial, talking about what the West should learn and see from rescue efforts in Xizang, referring to its Chinese name there, and particularly saying that this is the real truth about the reality of human rights. Now, Tibet, of course, has been, the focus of many, many sort of critics of human rights record in China, but the Global Times and other state media saying that actually the swift response really underscores the reality and the conditions and the care that the Chinese state provides for its people in that province.
All right, that was our Asia government and politics correspondent there, Rebecca Choong Wilkins, and we'll have plenty more ahead. This is Bloomberg. You're watching the China show, and we can get started really with what's a pain point for a lot of people in the city. And for people that are outside of Hong Kong, you might not be familiar, but I'm sure you face that frustration if you come here. You need cash for taxis in Hong Kong. And yes, it's
actual cash.
Actual cash.
Yeah.
It's 2025.
They're not free. We're not saying they're not free.
They're not free. Yeah, that's sorry. Need to make that clear. But you do need to actually pay with physical money, and that really kind of sets Hong Kong apart, especially when it's one of the biggest and most cosmopolitan cities in Asia. Well, that's what we say anyway. But There is a solution, possibly, because we do know that some cabs have been experimenting with digital payments, and we know the government, of course, is looking into this. They've proposed broader changes to overhaul the industry, including requiring that all taxis provide at least 2 forms of electronic payment. And here with us now is a company involved in that effort. That's called Dash. Samuel Wu is their Chief Strategy Officer and Managing Partner. Thanks so much for joining us this morning, Samuel.
Thanks for having me.
Talk to us then about the solution that you have in mind for this problem.
Sure. I'll bring up an example. I'm sure all of us would face this issue. Imagine you're in a hurry. You have to hop on the cab, and then you catch a cab on the streets, and you're now in the car. Halfway through your journey, you realize you have no cash.
Yes.
And what do you think is going to happen? Of course, the driver won't be very happy, and you keep your fingers crossed that he's going to magically produce a card machine, and you can pay by card. But statistically, I can tell you that's only not going to happen. You only have a 1% chance, because 99% of transactions when you hail a cab on the streets, it's done in cash. And what we want to do here at Dash is convert that 99% of cash transactions into electronic payments.
A funny story, as you're mentioning that example, I mean, I can think of many examples here in our team, very early in the morning, we're trying to get to work very early, and then you realize, case in point, so people who are familiar with Bloomberg offices here in Hong Kong, right? So right across is the HSV building.
That's the only blessing, is that Citibank ATM.
It's the ATM across the street. But again, to the point you're making, right? You realize you don't have enough cash. You tell the driver, can we stop at the ATM instead of here? And then sometimes you'll get some pushback, a grunt here and there. But again, so where is the... So we know what the solution is. We've been talking about the solution for years. Where is the friction?
Well, first of all, I think this has been in discussion for over 20 years when we first rolled out, the tap payments and Octopus. I think back then is an issue of technology. The machines are expensive to install, and you don't know, should the owners of the cabs bear it or the drivers.
Right.
But nowadays, with technological advances, these machines are much cheaper to install, and also you have many, many forms of payment, which I think brings down the cost of having these payment solutions.
So the solution then, it's physical, and
yes.
What sort of, can I ask how much you get from each transaction? What's the payment fee?
Well, we charge a transaction fee because that's very common throughout the world when you use electronic payments. And we're working towards lowering those fees because you have many card issuers. So we work with banks, we work with card issuers, and also you have the QR code payments providers. They're all competing. And they're all hoping to lower their fees. And we hope to reflect these on consumers, on the drivers, on the taxi owners as well.
And, to be fair, I think compared to, I'd say 12, 18 months ago, you do see more taxis now being able to take payment in the Octopus, which I always have with me, which is, of course, the card. You do have a very small minority to take electronic payments, for example, that do have the app. What is you have conversations, of course, with officials on this government. What's the role of government here?
Well, we can see that the government is very proactive. A few months ago, they announced the taxi fleet scheme. One of the requirements of the taxi fleet operators is to install electronic payments. And this is required by them. And so this is a push towards better services, more convenience for passengers.
I don't want to lay any blame, but
blame me instead.
I am interested in the response then from the taxi group themselves. Is that where a pain point lies?
Well, they are also very happy to implement a solution. So the fleets I mentioned, actually they're already in the streets. Right? They're required to launch their new vehicles by July of this year. And when they get a new vehicle, they've come to us to install the meters. So the adoption, yes, they're very happy about it.
But talk to us about your business strategy then. So this is one part of the conversation of Dash, for example. So what else are your priorities this year? And who would you consider competition? I'm curious.
Well, as I mentioned, 70% of taxi rides is still comprised of people just waving down the cab on the street. So,
right.
if you're talking about apps, pre-booked taxis, they consist of 30%. So I would say we're helping the industry, the majority of the transactions to go cashless.
Right. And your specific targets for Dash, for example, as you look at the company per se?
Well, right now we're focused on installing the meters because it's a mechanical electronic device. You have to get it installed with technicians, and but of course we've been looking into other verticals, vertical businesses that we would really explore when we have the installed base ready.
What are those other vertical businesses?
Yeah, I'm curious.
Well, I can't really drill into specifics. I'm happy to share a view when it comes out, but. Think about it. You're on a taxi. It's the beginning of your day. You're starting a journey, or you're ending your day. You're coming back from somewhere, you're going home. Okay. Yeah. So it's the two outcomes, and what is there? That's where we're looking into our verticals. We're completing your day. That's what we're hoping to do.
Samuel, I think I speak on behalf of many people. I hope you guys will be successful when it comes to this, of course. The 90% of the weight of my wallet, which really doesn't have anything else but coins because of this conversation we're having here. So Samuel Wuther, thank you so much, Chief Strategy Officer, Managing Partner at Dash. Oh, we could be here forever, really. Lots to talk about there. Okay, you can get an insider's guide to the money and the people shaking up the finance hub here in our Hong Kong edition newsletter. It's out every Thursday, so the newest one is already out on the internet. You can sign up via Bloomberg.com/newsletters. Plenty more ahead here on the show. Market roundup, plus some big moves and some big items on the agenda to watch with a Greater China conversation coming up on your screens. A beautiful but rather chilly Friday morning here in Hong Kong. Happy Friday. You're watching The China Show. Right, big mover to tell you about this Friday. Sunac China, property developer, receiving this liquidation petition filed in Hong Kong. So yes, the story isn't over. We are seeing some green shoots in some parts of the broader debts conversation. Vanco, for example, this week also had some updates as far as they were concerned. Country Garden, in case you missed it, had laid out its restructuring plans in front of creditors. So we'll continue to be on top of the story. That's point number one. Point number two is the PBOC and a lot of the headlines which came through earlier on. So reason why when you look at the currency and look at why yields are higher, the currency is stronger. The PBOC came out, and I think the graphic's about to show you this, some temporary changes to its open market operations. And also, do we have that? Is it coming? No, it's not. Okay, the other thing is, on Tuesday next week, there is a briefing. There we go. Thank you so much. Taking place, PBOC and SAFE, and we are in the window for credit numbers for December, Bill.
Yeah, this has really been one of the big things of this morning, halting the bond buying. But as you said, it's really trying to just temper that investor bet because they've been cautioning many times. This is not a one-way street. Yep. And this is just another signal of that pushback. But that's it for the China Show. Wishing everyone a very good weekend, and we'll have more ahead. This is Bloomberg.